Well, for anybody owning a property of £1 million, you're immediately falling into the realms of having to pay inheritance tax at a rate of 40%. And that's due to the way the nil rate bands and the residence nil rate bands work. The maximum possible combined nil rate band allowance for a husband and wife will be £1 million. And that's made up of two lots of regular nil rate band of £325,000 each, giving a total of 650. And the maximum residence nil rate band allowable would be for a married couple two amounts of £175,000, equaling a further £350,000. The 350 plus the 650 gives you £1 million. Anything over and above that million is going to be charged at an inheritance tax rate of 40%. That's the maximum. Depending on your circumstances, it may actually be that the amount of nil rate band available to you on your estate will be less than £1 million. So the £1 million is the best case scenario. The residence nil rate band is an allowance in addition to the nil rate band that applies if you meet certain criteria. And this is where it can potentially be misunderstood. So the criteria for the residence nil rate band is that you have to own your own property that you live in, and you have to have a direct descendant or descendants to pass that property down to. So children, grandchildren. Often people aren't aware of that piece of legislation or rule, as it were. So if you do not have children or grandchildren, you will not be eligible for the residence nil rate band. You also won't be eligible for the residence nil rate band if you don't own your own property that you live in. Another misconception can sometimes be that the residence nil rate band is not in addition to the normal nil rate band. They are two separate allowances that don't run concurrently. So you could have a nil rate band of £325,000 and a residence nil rate band of £175,000. Add the two together, that's £500,000 per person that somebody could be entitled to. Another kink with the residence nil rate band is that once an estate exceeds £2 million, the residence nil rate band begins to reduce, and it reduces at a rate of £1 for every £2 that the estate exceeds 2 million. So for a married couple, once a total value of the estate exceeds 2.7 million, the entirety of that residence nil rate band has been eroded. Yes, there are risks in that sense. Probably the biggest risk is that you have all of your planning tied up in one asset. What we would encourage our clients to do is to ensure that they diversify the assets they hold, to ensure that they aren't overexposed in any one area. And that is very important with the planning that we do with our clients. Potentially, tax reasons could be one of the reasons. I wouldn't let that drive the behaviour entirely, though, or drive the course of action. It feels to me a little bit like the tail wagging the dog. Now, the reason you might look to reduce your inheritance tax liability is in order to pass more assets down to future generations. However, it's my belief that that shouldn't come at the expense of your life. So if you've worked hard to buy a property and you're happy in that property, I would prefer that we explore other options and alternative ways of making your estate planning more efficient before we give up a property that you might be very comfortable and happy in, with happy memories in, purely to try and save some tax. So on second death for married couples, the marital home, the family home, would be distributed in line with, if you've made a will, your wishes. If you haven't made a will, it will form part of your estate and follow what is known as the rules of intestacy. So typically in this scenario, the family home will pass to the beneficiaries, and they will then decide what would happen with that asset moving forward, whether it's sold, whether it's retained, and they will need help and guidance around that. What we would encourage our clients to do is, whilst they're alive, is to make sure their family are aware and know what their wishes are on what they would like to happen with that family home when second death does occur. But ultimately, the answer to the question is it will be up to the trustees and the beneficiaries to decide what happens with that family home on second death. It can unintentionally increase it because of essentially the way tax legislation works in the UK. So, for example, a lot of people have invested in property and own more than one residence. So they might look at what we'd call buy-to-let portfolios. One of the main issues at the moment and under current legislation with buy-to-let properties is that it will more often than not give rise to additional income tax requirements. And if you ever dispose of the property, dispose of the asset, capital gains tax issues, as well as any property that you own is going to be included in the calculation for inheritance tax. So owning property can often be a triple hit tax-wise, because it's liable for income tax if you've got rental income coming through. It's going to give rise to capital gains tax if you dispose of the asset and you've realised a gain on the property, and it will also form part of your estate and therefore could be subject to inheritance tax. It can be, but it's something that you need to be very, very careful of. And that is because of the rules around gifting. And the main rule that trips people up when they are gifting property is what's known as a gift with reservation of benefit. So the rules around gifting are very, very clear in that you can make a gift, and if you meet the survival period of 7 years, that gift will no longer form part of your estate if it's what's known as an outright gift. Now, the condition is, not surprisingly, HMRC have to be entirely confident that it is a genuine gift and it's not an artificial gift and a transfer of ownership for paper reasons to avoid inheritance tax. So the gift with reservation of benefit rule, very simply put, is that if I make a gift to an individual, I can no longer benefit from the asset that I'm gifting. So if it's a property, I can no longer live in the property. So for example, I speak to a lot of clients who come to me and they talk about being advised and recommended to put their main residence into trust. That will fail for inheritance tax purposes unless you pay market value rent to whoever the gift has been passed to, or if it's held in trust, into the trust for the time that you live there. If not, the gift will fail for inheritance tax purposes. So that rule, that gift with reservation of benefit, essentially means that you can no longer benefit in any way from the asset you've gifted. So another example is a holiday home. You might gift the holiday home to your children. If you spent any time there, so even if it was for a week or a couple of weeks a year, what you would need to do is pay market value rent for the period of time that you were there. So it's an area that you need to be very careful around, and I would strongly recommend seeking advice for help with it. It wouldn't be exclusive to property, but any asset that is passed down, you need to think about whether or not you are simply passing on the problem with inheritance tax. So you're probably considering passing a property to your children because you have an inheritance tax problem. And if you pass that property as what's known as an outright gift, if you survive 7 years, it's outside of your estate for inheritance tax purposes. However, if your children in perhaps a couple of decades' time, when they're in your shoes, they may well have an inheritance tax liability and problem themselves. One of the things that you should consider, and again, should seek advice before moving forward in this area, is whether or not it would be a sensible idea to use some trust planning to support that transfer of asset. And we at Deep Dive would explore the options and make a recommendation to you and advise you as the best approach to take. But to answer the question really simply, the reason why clients might consider passing the asset to the grandchildren rather than the children is because it could be more advantageous from a tax perspective, particularly if the children are likely to have or already do have an inheritance tax problem in their own right. If planning is right for you, I would be suggesting that you should be enacting that planning at the earliest possible opportunity. The reasons why it would be more beneficial to do the planning prior to the property price increasing is that you're just addressing the problem a little bit earlier when there's less of a liability attached to it. But my view would be, if you know that a piece of planning is going to be the right thing for you and your family, you should do that at the earliest opportunity. Again, regardless whether it's property or any form of asset or any form of planning, my question would always be, why wait? And what are you waiting for? Are you waiting for legislation to change? Unlikely, in my opinion. Inheritance tax receipts provide a huge level of inflows into government coffers, which help with the huge deficit we have. So I'd find it very unlikely that terms on inheritance tax would ever be more favourable. And because of the nature of inheritance tax legislation and the rules, particularly around survival periods and the 7-year rule, if you know that a course of action is right for you, implement it. And if you're stalling, why are you stalling? Because there is no advantage to waiting.